All right, so Jerome Powell came out and he gave his statement today on behalf of the Fed and what the money printing plans are for the foreseeable future. And also, he did a big question answering session with the FOMC, the Federal Open Market Committee, and had a bunch of representatives of different, journalist associations asking him tough questions. And so what we get is the same official interest rate from the Fed here, just around zero for the Fed funds rate. And I've done a couple looks at the Fed funds rates before, but just if you haven't seen the whole chart, this goes back to 1955 and then 80s. Inflation was sky high here, and this is where Volcker had the Fed funds super high to fight inflation and bring it down. And then you can see down here, we're getting really low inflation, and the interest rates are right about zero again. And so that was the basic report. Um, just whatever he was reading from the teleprompter was that the Fed funds rate is set to be close to zero until 2022, is what he said. And close to zero, I don't know. I mean, that's a little bit fuzzy. I mean, basically, right now, it looks like the bond rates and the interest rates are not trying to push it anywhere else. And they're projecting low inflation, like their inflation targets, they're underneath. And Jerome Powell basically said it's humbling right now to try to create inflation. They're trying to create inflation and not able to right now. And also the jobs, he said, is very humbling, trying to create jobs, which the government doesn't actually create jobs unless it's a government job. But they I mean, yeah, I mean, they officially announced the Fed funds interest rates, but that's not really where the interest rates come from. I mean, this is the U.S. Treasury bonds being traded on the open market, and they're traded based on inflation expectations and on GDP expectations. And the interest rate is a response to that trading, and the Fed doesn't really control that. And if you just follow the long-term trend while inflation was increasing here, the interest rate just naturally works its way up when inflation is going up, and then when inflation is coming down, it works its way down. And that's what you see here. And then around this time when Volcker was in, I mean, they tried to get the Fed funds rate down, and it just didn't work at all, and inflation was going nuts. And so, I mean, Volcker really just set the interest rates where the bonds were trading, and that's what the trend is. And I've done a little look at the Fed funds rate before, but I mean, you can see just looking at the chart, this is just a normal wave pattern of the trading against the GDP and inflation expectations. But where you can really see the Fed intervening, and this is what the Fed actually does, they don't really decide the rates. They guess at what they're going to be, and then they try to fix them. And you can see when you get this kind of a sideways line like this, that's like not a natural trading pattern. That's the Fed. This is the Fed trying to set a rate. And so what you'll see the Fed do is they like it when the interest rates are going up. Generally, that's a sign of strength in the economy. So, I mean, like for instance, here pretty recently, when the interest rates started coming up, they're announcing like, oh yeah, we'll be raising interest rates for a while, and then it stops going up, and they're like, all right, we're gonna hold them, we're gonna hold the interest rates right here. This is a good level, and then they're trying to hold them at this level, and then the bond trading just presses the interest rate down lower than where they have it set, and then they come in with like, oh, there's an emergency rate cut, because usually if it's sideways or up, they're just they're just adjusting the official rate they're announcing on normal scheduled meetings. But when it drops, like they're trying to announce that it's up here at this level, and then they have to come in and do emergency announcements that aren't on scheduled time. They're like, okay, it's going lower, it's going lower. So I mean, just recently you see this where they're holding it sideways, and then the next one is down. And so if they didn't come out and try to force it to be here, it would have just gradually went down. But since they held it, then it's a big drop to where it is anyway. And right now they're holding it just above zero. And so I don't know if the normal interest rate is trying to go below zero or not. If you follow this, this pattern where it's like this angled, edgy thing, really, I mean, if you just smooth the curve out, like that's what it would have done if they didn't try to intervene. It would have just done just about the same thing. Or like on the top here, instead of a flat top, it would have been, a little curved. Or like this one here, where it's like they're trying to hold it sideways, and you can't because that's not where the bonds are trading. And it just goes down, and then they held it at zero. But I mean, if it was really trading down here, they wouldn't have been able to hold it at zero. So I mean, it could have maybe just dipped a little bit and come back up. But I think this zero interest rate policy is not them intervening, because I don't think they have the capability of intervening to that extent. And you can see it waving here anyway. Um, But yeah, when you see these sideways patterns that kind of break the smooth trading pattern, that is what the Fed does when they intervene. And it doesn't work. Like, it just works for a few months or whatever. And then it just gets back to where it was going to be anyway. And that's what you get here. Like, they're holding it here, and they're like, oh no, it's down here. So if you just kind of follow the chart, you can see really where it's trading. And uh, And then we had a steepening yield curve I was looking at last week, and now the yield curve is less steep. It's coming down. So the short end of the curve is right close to zero here, and the longer end of the curve has come down from, it was like 1.7. I think now it's down to like 1.3 or 1.2. So the yield curve is actually flattening again. And this is the thing to watch, is how these are actually trading, and looking at the bond trading. And the Fed funds rate, I mean, they can announce that it's zero as long as they want. But I mean, if it really trades negatively, it's not going to really matter what they're announcing. Like, it's actually going to trade negatively, and they can say whatever they want, but that's where it's going to be. But for right now, it doesn't look like it's trying to go negative. And it's kind of tricky if you're just following this. I mean, it's just there, and we don't know if it's going to try to keep going or not. And it doesn't seem to go negative very often. But across the other banks, in Europe and England and Japan and all that, like most of those banks have negative interest rates now. And the Fed is going to say that they're not going to negative rates. They'll always say, like, oh, we're holding it right here. And I don't know, how long can they hold it there? If it's trying to go negative, they're not going to be able to hold it there. It's going to go negative. But anyway, that's just a look at the interest rates and how little control the Fed really has over them. And several key points. Well, I would say, as with regards to the balance sheet, he did go into depth on what they're doing. He said they're going to continue to be buying bonds, like they're not changing that policy, but they're not really buying a whole lot of bonds right now. They're just keeping that as an option. And he said what they're buying right now is mortgage-backed securities and treasuries. And he said they will, well, they've tapered it down a little bit to this point, and he said that they are going to keep purchasing at least the same amount that they're purchasing now. So they're not reducing purchases right now. So that's a important indicator on the sort of liquidity outlook, is that they're not going to be tightening the liquidity from their end. But we do have the U.S. Treasury issuing way more Treasury bonds than they were. Like, the federal deficit is almost double so far at this point this year, and the treasury bond issuance has gone up like week over week or month over month. I mean, it's almost like 4x the treasury bond issuance. And so treasury bonds take liquidity out of the system to be used as government spending. So that's less liquidity. If the Fed stays still and the Treasury way increases the Treasury issuance, then that'll be less liquidity. But the Fed hasn't really agreed to stay where they are. Like they maybe will buy more, whatever. I mean, they can go up from here. He basically said that they're going to print or do whatever they have to do. And he gave basically a 2-year outlook and said they're going to try to keep the interest rates sort of near zero for the next year or two. And I mean, that probably would happen on its own unless inflation started going crazy. I mean, how close to zero is near zero? I don't really know what that means, but right now it seems to be trading around zero anyway, and they're just holding it. They're announcing that it's still close to zero on the Fed funds rate. But the bonds are starting to come down again, and so that's the thing to watch is the bond trading to really guess where the interest rates are going. Yeah, but if the steepness of the yield curve is decreasing, or if it goes back towards like a flatter yield curve, like right now over the next couple of months, then that's like a whole nother contraction cycle that we'd have to look at. So just looking at the bonds and the yield curves, it's low. It's low inflation. It's not negative yet, and that's just forecasting a long recovery. And yeah, Jerome Powell in the discussions and in the conference said basically that the unemployment figures are underestimated. He just said that plainly, and he pointed out the different like the U3 and the different unemployment measures that the government does, but the actual jobs lost, he was saying like 20 million, probably closer to 24 million, depending on how you count different furloughs and this and that. And basically said 2 months. They're planning on not really changing anything with the Fed policy over the next couple of months. They said that it's positioned well right now, and they just really don't know which way it's going to go, towards deflation farther or inflation farther. They just don't even know where they are right now. And so the Fed is just ready to respond, but they're not doing anything right now, basically. And I mean, he said a whole lot of these jobs that people are expecting to get back there are going to be permanently lost or long-term lost, and basically hoping in 2021 to get back a portion of what is lost in 2020. Like no indication of like actually recovering even in 2 years. Just trying to get back part of what is lost. So on the real economy, I mean, just tons of jobs are being destroyed, and there's tons of companies facing insolvency. And like what the Fed can actually do, I mean, as far as like the pandemic goes, I mean, the Fed, they're like, I mean, we're not, pandemic experts. Like, we can just do loans. And so that's, they don't have the power to do spending. They can issue loans that they expect to be paid back. And any kind of spending, is on the Treasury and the Congress. So that's basically, what he said is they'll do what Congress asks them to do, and whatever they need to do, they'll do it. But he said they have a lot of tools that are in full use right now, and they're being really aggressive with the tools that they have. But the truth is, they really don't have that many tools. I mean, the main thing that they like to do is drop the interest rates, and they like to drop them. Well, not that they even have control, but when a business cycle ends and kicks again, it's generally like here's like from 6 to 4, from 5 to 0-ish. So, like a 5 or 6% drop in the interest rates usually will kick another business cycle. But from 2 I mean, where's it going to drop to -2 or -3 or something like that? Um, and would that even kick another business cycle? It goes into negative territory. So, I mean, they're saying they don't want to go into negative territory, and they aren't going into negative territory right now. But we'll see how it actually trades. And if it does go into negative territory and gets steeper, then that's a deflationary indicator. And if it does start going up from here, so I mean, it's possible that we've already finished like this sort of down cycle here could have ended, here during this last period, and this could be the beginning of higher inflation and higher interest rates that we're already in now. But it's at 0 now, so probably not. Like probably if it's going to reverse, will be after now. We'll see if it goes negative. But that was kind of the Fed outlook. And then when he was answering questions, I mean, there was a really good question, like right at the end. Someone asked him, like, do you think the stock market is in a bubble now? And will the Fed, as far as malinvestment goes and risk, like what kind of responsibility is the Fed going to take for this? And I mean, he basically said like the stock market is just not the Fed's job, and they focus on employment. And really, the number one focus is making sure the banks are functional. So, like when we had the big contraction and the big crash, that was because the banks, the whole market was not liquid. It was not functional. And so everything that they did was to just make the system functional, so that loans could be issued, and so that banks were able to lend. And so basically that liquidity problem has been solved. And now, if the stock market is up or not up, it's like not their responsibility. And he said point blank, like, I mean, even if they thought the stock market was bubbled or it was too high, like they would never change policy to like try to bring the stock market back down to where they thought it might be or where it should be or something. Like that's just not their focus. Like they're keeping the banks functional, and they have inflation rate targets, which he said they're not even close to reaching their targets right now. And even over the whole last like 10 years, they weren't getting to their targets. And now he said it's extremely humbling he's basically announcing like a deflationary situation where they can't get the inflation, and they're looking to keep rates low for several years, to try to get the economy going again. And they expect a huge amount of job losses, and he said 2 months basically to watch what happens with the pandemic and see if there's another crisis or not. But he specifically mentioned 2020 as a time when they would be looking at the interest rates at basically a non-zero. He said 2022. I'm sorry. And he said 2 months from now as the next time they'll probably be looking at adjusting the policy based on the damage to the economy and whether or not the pandemic has another whatever wave or a crisis. So yes, I guess on the liquidity thing, that was the main thing that I was really trying to listen for is what's the Fed's liquidity policy now that the international banking system is basically functioning. And he didn't say that it is functioning well. He said that it's still messed up and that it's basically functioning now. Which I was surprised that he was just like, it was yeah, that was really interesting. The like the speech kind of he just read off the teleprompter, but when he's answering the questions, I mean, he's pretty frank about the unemployment numbers being lower than they really are, and just the statistics, the way that they're counted, and the job losses that aren't going to be coming back, and the He didn't like get into solvency issues, but yeah, just saying that his job is to keep the banks functional, basically, and not to worry about the stock market. So um, if basically if the Fed needs to buy more mortgage-backed securities or treasuries, they're going to do it. But as for right now, they're not increasing like today their purchases. But he said at least what they're doing now, and so they've tapered it down a little bit, but they're not looking to go lower than what they've done right now. They're holding it where it is now until it needs more, and then they're going to do more. That's what he said. So as far as the liquidity outlook, it still seems to me like way more treasury issuance and the Fed kind of standing still. Like right now is going to be less liquidity in terms of the stock market. And then we will have to watch the Fed balance sheet to see how they actually respond. But that's what he said today. And that was really the one thing I wanted to hear was, well, I mean, the interest rates, I didn't think they were going to announce a negative interest rate. Um, but I do want to see if they are trending down still, and it looks like they are, because we got kind of a little spike the last 2 weeks, and they're trending down again now, and so that's kind of the thing to watch. The interest rates, are they trending down? If they're going to go negative in America, that is a whole deflationary scenario with the dollar versus other currencies and potentially commodities versus the other currencies. And deflationary does not mean that they're going to stop printing money. That just means that other currencies go down versus the dollar, and probably commodities go down versus other currencies. It's just like what's valued relative to other things. Um, but if they are able to get inflation, I don't know if that's more scary, because in that case, the dollar is really crashing, and basically everything else which should be going up against the dollar. And then interest rates would be going up, and then the debt burden is a monster, and the dollar is just like losing value, and that is a huge, inflationary mess that could end the dollar as the reserve currency, um, versus the deflationary scenario, which is just like horrible economic conditions for everyone for a long period of time. Um, so, I mean, I guess if the dollar started going into high inflation, uh, the rest of the world would be racing to other monetary alternatives, and America wouldn't be able to do much about it. Um, and that would end up benefiting the rest of the world greatly, to not have the dollar like holding them down. But it would be terrible for America, because America produces nothing except except dollars. That's not true. America has big food exports and a lot of industrial production and like airplanes, and but the economy of America is not designed to support America in the event that uh, America deglobalizes and loses the world reserve currency. It would be devastating. Um, so yeah, so as far as the stock market goes, let's pop over here and see what's going on. Um, it sounds to me like right now, over the next couple of weeks, there will be less liquidity, until the Fed decides to respond again, because the Treasury is continually stepping up their Treasury issuance, and the Fed is not stepping up their purchasing right now. And so we're just kind of hanging out. It might be breaking down a little bit on the S&P, but this is the 2-year tangent line. That's a bull support line from the bottom of the 2018 crash. Let me go out to like an hourly. Yeah, so that. Oh, what? No. where am I? On 1 hour? Okay. So this is the Volmageddon. It's a bull market support line that goes back a couple of years to the bottom of the 2018 crash. And this is where we broke. Let me pause it. All right, there we go. Sorry, the internet is slow, but this is where we had our crash here. I'm calling the everything bubble blow off top. And we broke this Volmageddon trend line, backtested it, and then we made it down here under the next trend line and just completely ignored it and ran all the way back up to this Volmageddon trend line. And so this is fully active in backtesting this this 2-year trend line right now. And so this is the thing to watch now. In the bearish case, if we reject off of this trend line, do we actually terminate this trend line and start working our way down the backside of the everything bubble? Can we get above this trend line and use it as a bull support line, as we have for the last 2 years? But now that we've broken and backtested it, we're looking at whether it's a bull or the bear case. And so like on the technicals, getting above this long-term moving average is sort of out of bear market territory into bull market territory. Just on the technicals, but on most of the fundamentals like the VIX, we're still at high volatility and going up. And so, I mean, volatility in the 20s on the VIX is this bear market volatility. And, you know, for like the financials, oh yeah, the financials are breaking down. It looks like more than most of the other sectors here. And so the financials probably don't like the zero interest rate news, and the super long-term outlook of not raising the interest rates is really, really bad for the financials. But more so, just the financials is an indicator of the general economy. And so, I mean, this is still a bear market outlook. You know, getting up to the moving average on the financials and rejecting. If it stays down below the moving average for the next couple of weeks, it's very bearish for the main economy. So this still looks like a bear market from the fund. I mean, obviously we're in a recession and the whole world is in a depression, but it's a different thing to look at like the fundamentals, like price earnings ratios and things like that, versus kind of fundamentals like the VIX and the XLF and things like that. So the VIX and the XLF are stock market kind of fundamentals, and the general economic outlook is obviously a recession, but that doesn't like just having a recession does not mean that the stock market is going to go down. If we get into a high inflation scenario, like the stock market should go up, way up, like everything should go up. But from the Fed meeting today, it looks like it's low inflation, lower than they want, and it looks like, I mean, Jerome Powell is predicting a year or 2 years to even start getting inflation back up towards their target. And I don't know why, like what he's basing that on really, because I mean, just being in a recession doesn't mean that you can't get inflation. Like we could start getting inflation next week. It could get out of control a month from now. Like, but it's largely just looking at the bond trading and stuff like that to see if the inflation outlook is going up or down. And right now, it looks like it's moving down a little bit more, and the financials breaking down is pretty bearish, and the VIX going up with very little movement, back up to 27 or something. Yeah, because it came down to 23. If it gets down to like 15 or something like that, like that's getting towards, you know, kind of where this gap is over here. Like if it starts filling this gap, that's getting into bull market territory. But you know, bouncing up here off 20 back up to 30 range or something. This is bear market territory on the VIX. So that's just kind of the outlook. If we're not getting very much inflation and the volatility stays high, then it's basically still a bear market scenario. But then, everyone says like the Fed liquidity flooding the market, like the market can still go up even if it's in a bear market, which I guess is true. I mean, it made a huge bounce, but also if you're just looking at the model of the crash or of the bubble, like there's nothing weird about uh, backtesting a trend line on a bubble. I just thought that since we already have tested this thing and got to the next trend line, I thought that we would be done with this one. But whatever, we're up here hitting it. So it looks like we're just testing this first trend line. And so that's kind of the outlook on the backside of the bubble is if we do get a deflationary kind of scenario, and we are unwinding on the backside of the bubble, then we can look to see if this 2-year trend line gets back tested and gets terminated. In which case you would be looking to move down below the next trend line and back test it, and that could happen relatively quickly. If you terminate this trend line, usually it's a pretty quick sell-off down to the next one. And, we could move around in here, and it could be 2 days if we're going to terminate this line, or it could be like 2 months of wobbling and jumping around. Like on the Nikkei, I think it was like 6 months of a bunch of action really close to the trend line before it finally broke down to the next one. And yeah, there's just not really a amount of time to when it terminates the line and drops, but there is downside risk if you are in fact on the backside of a bubble. If this is a bear market, if we are terminating this line in the bear market case, that sell-off can be pretty quick, and that's kind of a thing to look out for on the bear market side, is if we're terminating this and moving down to the next one. And on the bull market, I don't expect like this green line to be a longer term bull market trend line. I think if we do a bull market kind of thing here, if we're switching into a bull market, I think it would be more likely that we stick on this trend line, like this angle, as a long-term line. Unless, yeah, I mean, right now there's no indication that we're going into like high inflation or something like that. But if we did get indicator of high inflation, we probably would switch out into a higher angle bull market line in the case that it is actually going up. But even with high inflation or even hyperinflation, everyone says the stock market goes like up and up and up, and there's a lot of cases of that happening, like with Venezuela, Zimbabwe, and all this stuff, or Greece or something. But those were not world reserve currency countries, and when you have hyperinflation with the world reserve currency, like with the Dutch guilder or something like that, when you get hyperinflation with a fiat currency at the end of like a reserve currency empire, I mean, it's not guaranteed that the equities go up. Like the Dutch, like the Dutch East India Company, which was basically like the Dutch government, was like a business. That was like the whole spice trading empire, and that was one of the first stock markets, or the first stock market. And they had a similar situation to this at the collapse of the Dutch Empire, where they had the interest rates and the inflation just going up and up and up at the end, and the money printing going up and up and up at the end of the empire. And the equities dove the whole way, like exact opposite direction of inflation, crashed to zero. And so there's no guarantee that that even hyperinflation would make the stock market go up long term forever, because this is a world reserve currency. And so that's just another thing to look at. I mean, in the crazy case like that, I'm not saying like that would happen right now. As for right now, it just looks like we're popping a bubble, and it looks like we're still in a bear market to me. But we'll have to watch the liquidity and the movement here. And let's check out. Oh, I don't know. What is the USO doing? Yeah, so it looks like oil is just trying to continue to work its way up. And the USO doesn't exactly track the oil prices. It sort of gets stunted on the upward moves, and it gets kind of exaggerated on the downward moves. And that's just the structure of the ETF, where you get compounding like every day. You lose percentages in the volatility, and then with the contango, when you're trying to move up, like you lose a little bit every month while you're trying to move up on contango. And so you'll see. Let's pop the actual oil in here, and you can see the actual oil price versus what the USO is doing. Yeah, so I mean, look at the oil price is going way up here, and the USO is just barely working its way up relative to the oil price. So like this thing is not tracking the oil price. But if you get in tight, and even over the last 3 months, you can see this whole structure. If you look at day to day to day, it looks like it's tracking it pretty well. But the more time you put on it, those little percentages that you lose every day, they really add up. And the contango and the percentages, I mean, you can see right here. Like, look where oil started going up, and look where the USO is going up. But I guarantee you, if oil does a move like this, USO will do an even bigger move, percentage wise, from where it is. And so that's just kind of the structure and the risk with the USO is that it just does not get the same up move as actual oil does, but it does get the big down move, and it basically locks in the losses. And if you track it long term, I mean, like the UCO and the USO and UCO both have this kind of structure with futures contracts. I mean, where the past price is ridiculously high, and it just never makes it up. And so this is a pretty smooth uptrend in the oil price. And so the USO is working its way up at the same time. But the more volatility that you get in the oil price, the down moves get exaggerated, the up moves get kind of stunted in the USO. So, I mean, basically, the USO is something that I would look to short, except that I'm bullish on oil. So you have to find a spot to try to short it where oil would actually come down. But I mean, if you could have predicted this oil crash and shorted it from back here, I mean, like look at the rebound. Like oil's halfway back up, and the USO is not even like 1/6 the way back up to where it was. So, um, yeah, that's a look at something completely unrelated to what we were just talking about. And this is not investment advice, and I think the liquidity is contracting right now. For this month, it looks like the bonds are way outpacing the Fed buying at the moment, the U.S. Treasury bond issuance, and that should be less liquidity in the stock market for the don't fight the Fed people. I think the Fed liquidity is getting contracted domestically right now, and the main liquidity was going out to the international market during the big international banking freeze. And I think that's where all the big extra flood of liquidity is kind of coming from that people are talking about, is just extra liquidity in the world market. And now we are going to have to see what happens. And still just I don't know. I think I like the deflationary scenario better as a more likely case right now, just based on the bond trading and the interest rates right now. It looks like we're not getting inflation yet. Not like inflation where the dollar is crashing way faster than all the other currencies and crashing relative to all the commodities and everything like that. Like in the high inflation scenario, like the dollar would be like the worst asset out of anything, out of any of the other monetary assets or equities or anything like that. And that is not, I think, what we're seeing right now. But yes, this is a man. It's just the huge crash and the huge rebound is just unprecedented. Like, there's not another bubble. I mean, I've studied like 10 bubbles, and I haven't seen a single other bubble that has done quite like that. And DXY, oh, the DXY is breaking down harder. Okay. Yeah, so the DXY is still making a powerful move down. And so that is an inflationary indicator. And uh, basically, for the deflationary scenario, that's interesting to have the DXY breaking down and the interest rates not responding at all and having the bonds trade down as well. That's really confusing. It should get a reaction from the other governments. And I'm in South Africa right now, and I know that the South African um, dollar shortage is no joke right now. Like this government here is having a really hard time getting dollars to pay the debts here, and they're going to the IMF this week and trying to ask for IMF to help them out and stuff like that. Um, and so, I mean, just like a kind of a commodity country, and I think South Africa has a swap line. I'm pretty sure that it does. Um, and I know that Brazil got one, but countries, yeah, like kind of commodity countries like Brazil that have high debt, or South Africa's commodity country, it should be really interesting ones to look at more in the short term, maybe Australia and Canada, and see if those currencies start reacting against the dollar sooner than just the DXY, because the DXY is a basket, but it's weighted a lot. The euro is the biggest thing in the basket for the DXY, and so the euro is not quite in the same situation as like individual commodity countries, or somewhere like India that has really high debt, or like Turkey has like crazy debt. Those are kind of the countries to look at to forecast a reversal in the inflationary deflationary scenario and the DXY. It's like the DXY should be pushing up when the EU gets in trouble, and that's something that could possibly happen later, but that's not like something to look at right now. I mean, I think the currency pairs here would be, yeah. So here's like the Brazilian real, for instance, and it's following the pattern. Like the real is gaining against the dollar right now, so the dollar is making an inflationary move down um, against even currencies like this. Or here's like the South African rand. This is, I think this is, well, this is a really good one for me because I'm in South Africa right now. Like this affects the price of my food at the grocery store, but but yeah, the rand is gaining on the dollar right now. And so this is a country that's having huge debt problems, and it's a commodity currency. So I think this is a really good one to watch. And I'm effectively shorting the dollar by being in South Africa and buying stuff in South African rand. Um, but yeah, but I mean, like this exchange rate that you're getting here was almost like 20 rand to a dollar or something like that, which was really strong dollar. Stuff was really cheap here for me over the last month, and this is a pretty big push. So here's Indian rupees, and India is not moving much against the dollar. So it looks like the commodity currencies are moving. Let me check like Canada. Yeah, so yeah, the commodity currencies, like all the commodity currencies are gaining against the dollar right now. So that should be bullish for oil, which oil has been gaining kind of the whole time anyway. Um, but that should also be a good look for silver. If we're getting inflation and plus movements on commodities, that should be positive for silver. And silver, yeah, I mean, silver is doing pretty decent. So we've already had a big push now, and I don't know how far to expect that to go. I mean, it seems like there's going to be a big reaction from the other governments if the dollar starts getting weak, unless we are really moving into high inflation, um, which I don't expect. That goes against kind of where the interest rates and the bonds are trading right now. So I don't think we're actually going into high inflation right now. Um, I think this is just a short term kind of push down for the dollar, and that is a big thing to kind of watch. Yeah, it doesn't. All the things aren't adding up where I want to go. Silver price is already kind of trading high. Yeah, it's not the kind of reversal where I would want to try to move on silver right now with the price already high and stuff like that. But in the case of silver, uh, this is my favorite silver miner, and they have been doing really well actually. And I wasn't trying to go long silver yet because I was looking for kind of a switch in the market conditions, and I guess we have gotten it now that the dollar is pushing down, but it wasn't like a clear signal when that was going to happen, so I didn't really get a jump on it. But First Majestic is a really cool silver company. It's a Canadian company, and the jurisdiction's mostly in Mexico for their mines, which is positive swap line, everything. And this is really the only silver company there is that has good jurisdictions, and it actually is a silver mining company because whatever it is, 80 or 90% of the silver is just a byproduct of gold mines or iron mines or whatever commodities or gold. This company is actually a silver mining company. They focus on silver, they mine silver, and they also are the only company that mints their own silver coins. So, like, you could go to the First Majestic website, and they have their own silver coins that they mint that you can order directly from them at probably a cheaper price than pretty much anywhere else that you could get silver coins. Um, but they were over $20 an ounce for the actual coins, even when silver was trading at like 11 and 12. Like, the coins have been 21 or something the whole time, and now silver prices are up to, I forgot what they were, like 16 or 17. And the coins, I checked this site a few days ago, and the coins are still trading at like 21 or 22. So the physical coins are not the prices aren't really moving relative to the spot price of silver. Um, but in the event that I do see a good entry point into silver, this is probably what I'll be focusing on. This would probably be the move that I want to do. Yeah, and I don't. If we're actually getting inflation and a positive commodities environment, which the commodity currencies are suggesting, um, silver and the silver miners should be doing better than this right now. Where let me throw. Yeah, I threw the DXY up here, and so you can see like this big move up in silver happened before the dollar started breaking down, and really silver has just kind of stayed flat while the dollar has been coming down. So yeah, that's not a combination of indicators that makes sense for me to go long on this right now. In fact, there's not a whole lot of things that make sense right now. Let's see what the tankers are doing today. I like to use TNK. This is TK Tankers as a look at the tankers, just because it's a bigger company and it's less volatile than the other tanker companies. And we got this really good sort of consolidation zone here that looked like a bottom. And so I went long on the oil tankers, um, which is good. They're back up. So I'm definitely up a little bit on the oil tankers, while the rest of the market is just kind of in this crazy whatever it's doing right now kind of thing. But this could be a potential breakout spot for the for all the oil, for all the crude tankers. Maybe on a man, I don't know if the stock market starts pulling down. I really want to see what the tankers do if the stock market starts coming down. Because I mean, they were following the general moves that the stock market was making, but kind of on its own trajectory here. But like this huge move down in the tankers happened while the stock market was making a big move up. And so the correlation between, well, between the normal equities and between oil, like oil still looks like it's moving up. And anyway, this is a long position for people that are looking for long positions, and this is not investment advice, but these tankers like BHT, like double hull tankers, I like this one. I like this one because it is it's a smaller, more volatile kind of tanker company as far as a short-term trade goes, and it made it down here below the moving average, and it looks like it's a good spot for like a turnaround. Versus like NAT, the Nordic American tankers, which got that huge hypey move. Oh, here we go. Yeah, so Nordic American tankers made a huge, parabolic peak reversal thing up here, and it's come down. I mean, it went from like two something to nine. So yeah, it got crazy hypey because of the big move up. But this was just kind of a BS thing up here. I mean, it really just kind of traded in this zone as far as the actual price action. But but it did, like when TNK kind of forecasted a switch, like this thing switched, and it's just straight going up now. While the other ones are doing kind of big wavy movements. So this might be a better long in terms of just hypey nonsense, because people uh, have really been looking at this company a lot recently, and it gets a lot of press that the other companies don't. But fundamentally, I think the double hull tankers and TNK and probably Frontline are getting way less hype, and possibly Euronav as well. But they're following the same trend. Like this is the whole crude oil tanker industry is kind of getting this reversal here. Yeah, so Frontline is doing this as well, and it's only swinging between. No, it's still pretty big swings in Frontline, and then Euronav. This is another big one. Frontline and Euronav and TNK are kind of the bigger ones. But I really like looking at the TNK chart, um, just because it has way smoother movements and it's just easier to kind of use it for technical analysis. Whereas like Nordic American Tankers is completely spastic, like small company. Or yeah, here Euronav's getting kind of a reversal too. But this one gets less price swings, and so yeah, I think TNK is the best big company that's had the most bullish kind of chart, and I think DHT, the double hull tankers, probably has the lowest entry point for good reversal as far as fundamentals go, and the most upside fundamentally. But I think NAT, the Nordic American tankers, has the highest probability of getting a hypey kind of another hypey parabolic kind of peak, and could potentially be a good thing to watch as far as hype goes, because if NAT kind of blows up and gets crazy hypey like this again, um, that might be an indicator to be careful with all of them. But Yeah, but this is pretty cool because it's not making the big swings that a lot of the other ones are making. Like this is a pretty smooth descent and then a pretty smooth takeoff here. But it's the same point that the other ones took off. So yeah, Nordic American is one to watch, and I'm not long on Nordic right now. I just have TNK and DHT right now, just because I thought those charts looked better. But the hype play on this one might be a good play, and I think it could pretty easily climb up to these targets over the next month or so. I mean, think I don't really think it's gonna go hypey like parabolic or something right now. I think we kind of missed that. I think we kind of ended that parabolic crazy stuff. But um, the important thing to watch right now is, well, it looks like financials and small caps and things are moving down now. The general S&P is just kind of hanging out, and I really want to see how the tankers kind of react to what the stock market's doing. Like, is it gonna be a bullish move while the stock market's coming down? Because in that case, I think these would be a good long. The crude oils would be probably a good long over the next like month or two. And if they start pulling down with the market, if the market starts coming down, then have to kind of reevaluate what's going on. So that's just to look at a bunch of random stuff that really is not all lining up. Like the fundamentals and the indicators and the different sectors just really aren't painting one picture that makes any kind of a move make sense right now. Um, like every single one of these could break either direction, and they're not correlated in a way that makes sense right now. So this is just high volatility, crazy stuff going on still, and it's really hard to find. Well, safe moves are extremely hard to find, but like I mean, good moves. I don't know. It just feels kind of like a crapshoot right now. And I'm not seeing the high inflation scenario that would be really good for gold or silver right now either. Um, so I guess for the bulls, I mean, things like Tesla and stuff just keeps going up, right? So um, probably, I mean, the bigger companies, you know, Apple or Tesla or something like that, seem to still be just kind of going up. And then for shorts, oh yeah, Tesla, man, Tesla's crazy. Yeah, so we got into kind of this pinch here, and I was looking at calls and puts, and I figured it would pop, and it did. It popped up. I thought it might pop down though, um, but yeah, that's a monstrous pop up for Tesla. Tesla's absolutely nutty. Um, so that's really cool. Good on Elon and Tesla, I guess, right now. And I don't really know. I don't really know targets. So this kind of downtrend here just got destroyed, and that's kind of a cool thing to look at. Probably because Bitcoin has kind of a similar downtrend that is kind of trending above right now. So I'm wondering if Bitcoin will break out to the upside soon, although it's completely different. Well, I mean, as far as the hype goes, they're similar on the hype train. But yeah, so I mean, Bitcoin has this long-term kind of downtrend, and it's just a little bit, above it, but it hasn't really broken out of here yet. But Bitcoin kind of has this wedge thing going that could run out maybe towards the end of the month before it kind of gets into that spot where it needs to break, kind of where Tesla broke, and that could be an interesting spot. Maybe I don't know. Yeah, towards the end of June, maybe it might be squeezing into the spot where it needs to pop, and I would expect Bitcoin to just kind of keep doing this stuff for a week or two. Um, yeah, where's the? Yeah, so the small caps have rejected down, and I think so. That's the Russell 2000, the IWM, and I don't know. IWM is the dumbest ticker for the Russell ever, but XLF has also kind of done a sort of like a parabolic reversal. It's come down a lot farther than I expected. Yeah, so I guess this week is going to be a really important week to look at different sectors and see what's really moving. And I think the Fed announcement is probably not good for the XLF with long-term zero interest rates basically forecasted. That's awful for bank profits. I mean, the banks make money on those interest rate spreads and there's no interest rates, so there's like no. That's awful for the financials. Fundamentally, it's bad, but I mean, if the market doesn't care about fundamentals, then who knows? Uh, but this looks like it has been and is still kind of bearish on the XLF. And yeah, so I'll get more into the different sectors this week and try to figure out if there is actually a pattern that makes sense here, or if everything is just going to be a conflicting mess that doesn't really paint a picture of what's going on. Um, but I think that these look like they're going to continue to break down, like the small caps and the financials. And then as far as the tech, info tech sector is still doing buybacks, and it's hard to predict what's going to go on with those. I mean, they're in crazy land, but yeah, XLFs and IWMs probably should be breaking down now, and DXY. Very important on the DXY to see if it is going to continue to break down or not, and especially against the commodity currencies. I mean, what does that mean? Um, yeah, yeah, probably bullish for oil to have the commodity currencies gaining, and should be good for silver, but it's not looking that way. It's super weird. Okay, so I'll get into the sectors more this week and try to figure out if there's some actual patterns going on that make sense for trading. Um, but as for now, I think really, I mean, probably info tech sector that's still doing buybacks for longs is the best sector if you're bullish and looking for longs. I still think that is the sector that has the least exposure to the risks that are happening right now, and probably the small caps and the financials have the most exposure to the low interest rates and the solvency kind of risks that are going on now. And I do like oil. It's too high too early, and the USO is a really bad way to go long on oil, just because of the structure of the ETF. But um, But yeah, and you can go look at my playlist and the oil thing. I have a bunch of videos that go over the structures of these different ETFs and ETNs. And there's one called the SCO, the short crude oil. And the short crude oil, if you short the short crude oil, that's a way to go long on oil, where the contango and all the contract stuff is actually working in your favor. Um, so that's one thought for going long on oil with kind of these, levered ETFs and ETN kind of things. Um, and whatever, that's good enough. Talked way too much on this stuff, and it's just a bunch of macro stuff that's not painting a clear picture yet. But hopefully, it does kind of clean up where stuff makes sense soon, where where we can take a look at actual trades that are high probability rather than a complete crapshoot. And happy trading.